Hi, welcome to the Crypto Republic. Before we dive in, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. The Federal Reserve just detonated a financial bombshell, one that's rippling across every corner of global markets. 55 crypto ETFs are reportedly in motion. Trillions of dollars are shifting, and gold, the world's oldest store of value, just watched 1.7 trillion vanish into thin air. Now, you think that's a coincidence, but it's not. This is the beginning of a monetary reset, orchestrated quietly, methodically, and with precision. Today, we're breaking down the real story behind the crypto ETF tsunami and what the Fed's new stance is, what this means, how it connects to Ripple, BlackRock, and the global liquidity corridors, and why this could mark the moment when crypto moves from speculation to infrastructure. Because make no mistake, this isn't just another Fed headline. This is the institutional green light crypto has been waiting for. Let's rewind to a moment that slipped under most investors' radar, a quiet payments innovation conference hosted by the Federal Reserve. For decades, the Fed and the crypto world were adversaries, two parallel systems, each distrusting the other. But this time, the tone was different. Fed officials didn't talk about banning crypto, they talked about building with it. Fed governors went along to say distributed ledgers and tokenized assets are no longer on the fringes. They are now woven into the fabric of modern finance. That one line buried in a transcript marks the turning point. Behind closed doors, the Fed has been studying tokenization, experimenting with smart contracts, and even testing blockchain-based settlements within its own internal systems. Think about that. The same institutions that once warned against crypto volatility is now exploring how DeFi infrastructure can modernize its own payment rails. And here's the kicker. This isn't theoretical anymore. They're designing a limited access master account system, the so-called skinny account, to give crypto and fintech institutions direct access to the Fed's payment rails. In other words, no more middlemen, no more dependency on legacy banks to clear blockchain settlements. This is the digital equivalent of Fed opening its vault doors and saying, welcome in. At the same time this was happening, something else quietly exploded, the ETF filings. As of last count, 155 crypto ETFs tracking 35 different digital assets. That's not a coincidence. It's a land grab. This is Wall Street's version of the California gold rush. Only this time, the gold is digital. Bitcoin and Ethereum lead the pack. XRP, Solana, and even newer projects like Chainlink are being structured into institutional investment vehicles. Why now? Because once the Fed legitimizes distributed ledger technology in its own ecosystem, the signal to institutions was clear. The gate is open. Build. You can practically feel the capital rotation happening quietly beneath the headlines. Every time a new ETF filing appears, another door opens for pension funds, sovereign wealth funds, and endowments to enter crypto legally, safely, and at a scale. This is the on-ramp to the next bull cycle, and it's not retail driving it. It's the same money that once controlled oil, real estate, and bonds. But while crypto gets its invitation to the big leagues, gold just suffered one of the worst collapses in modern history. 1.7 trillion in value gone. To the untrained eye, it looks like panic selling. But if you follow liquidity flows, you'll see something different and deeper. Liquidity never dies, it migrates, just like water escaping a cracked dam. It rushes toward the next basin of opportunity. And right now, that basin is digital. It's poetic, really. For centuries, gold symbolized permanence, the immovable asset. But the same way the telegraph replaced the horse, the blockchain is replacing bullion. When the Medici family pioneered double-entry bookkeeping in the 15th century, Florence didn't just reinvent accounting, they invented scalability for trade. It was a technological shift disguised as a financial tool. Today's shift is identical, only the ledger isn't written in ink, it's written in code. And the institutions that once stored gold bars in vaults are now buying back tokens backed by blockchain infrastructure. That's the quiet truth behind the 1.7 trillion meltdown. Not destruction, but redirection. We've seen this movie before. In 1944, the Bretton Woods Agreement pegged global currencies to gold. By 1971, Nixon severed the tie, ushering in the fiat age. Each era ends when the infrastructure beneath it becomes outdated. Now, 50 years later, the code standard is emerging. A world where value moves at light speed, verified not by vaults but by cryptography. And the Federal Reserve, the same institution that once printed the very notes that replaced gold, is now positioning itself to oversee digital liquidity. It's not a one-world currency. It's a one-world system, an interoperable framework where stablecoins, central bank digital currencies, and crypto assets coexist across the same rails. That's what the Fed's Innovation Conference really symbolized, a bridge between the analog and the algorithmic. Let's look at the data. According to ETF filings tracked by Bloomberg analysts, over $500 billion in potential inflows could enter the digital asset market within the next 12 months once approvals roll out. Institutions like BlackRock, Fidelity, UNESCO aren't experimenting, they're positioning. They're buying infrastructure companies, partnering with tokenization platforms, and aligning with networks like RippleNet that already have regulatory clarity. Even central banks in Europe are quietly building out cross-border settlement pilots using distributed ledgers. The ECB's digital euro sandbox, the BIS project icebreaker, and yes, the Fed's own FedNow integration tests with tokenized liquidity providers. Each of these is a piece of the same mosaic, the Internet of Value coming alive. Throughout modern history, every major financial transition has come with the transfer of power. From the Medici's ledgers to Britain's gold empire to America's dollar dominance. Each time those who controlled settlement, not currency itself, ruled the economy. Today, that settlement layer is moving to the blockchain. And whoever controls liquidity routing, the plumbing of this new system will control the next century of finance. That's why Ripple, Circle, and other corridor builders matter. They're not chasing speculation. They're building the rails. The same way Swift once unified banks through messaging, DLT is now unifying assets through automation. The Fed's bombshell is a signal that the new infrastructure isn't coming someday. It's here. Now, let's be real. Not every headline is bullish. Think this kind of transformation always comes with volatility, manipulation, and misinformation. Retail investors are still being liquidated in masses, margin trading, leverage positions, and pump and dump cycles. Influencers glamorize risk while institutions accumulate. History repeats. During the California gold rush, most miners ended up broke. The ones who built the infrastructure, the railroads, the banks, the supply chains became wealthy. Today's equivalent, protocols, tokenization, networks, and liquidity providers. The builders of the rails, not the passengers. So as this ETF tsunami unfolds, remember, don't chase the waves, build where the tide is going. Imagine the next 5 years. The Fed no longer prints money in traditional sense. It tokenizes liquidity. Smart contracts replace interbank clearing. CBDCs communicate with private stablecoins through interoperable corridors. Gold remains a relic of history, revered but sidelined. And crypto isn't speculative anymore. It's the operating system of global trade. This is where we're heading. Not overnight, but inevitably. Just like electricity replaced candles or email replaced letters, every era begins as heresy and ends as heritage. Crypto is now crossing that line. So what does all this mean for you, the investor watching this right now? It means the era of isolation is over. Crypto isn't the outsider anymore. It's the infrastructure. But with that legitimacy comes consolidation. The Wild West days are ending. Regulation, standardization, and institutional custody will define the next chapter. That's why cold storage and personal custody matter now even more than ever. Because if 2025 is the year of institutional entry, 2026 will be the year of control. And the only way to preserve freedom in a programmable economy is to hold your own keys. The Federal Reserve's embrace of tokenization isn't the end of the old system. It's the bridge to the new one. And like every bridge in history, from Rome's aqueducts to the internet backbone, it will be remembered not for who crossed it first, but for who understood where it led. 55 crypto ETFs, 1.7 trillion in gold evaporated, a digital liquidity system rising beneath our feet. The shift is already underway. The question is, are you positioned for it? If this video opened your eyes, make sure to subscribe, turn on notifications, and share it with someone who still thinks crypto is just speculation. Because after today, that illusion is gone. This new financial order, and you're early. If this opened your eyes, smash that like button, ring the bell, leave a comment with your thoughts, turn on notifications, and most importantly, subscribe to the Crypto Republic, bringing you the truth about XRP, global banking moves, and the wealth transfer already unfolding. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic.